Welcome to Daybreak Australia. I'm Paul Allen in Sydney. We're counting down to Asia's major market opens.
I'm Annabelle Droulers in Hong Kong, and the top stories this hour. Asian stocks set for early gains after tech heavyweights lift Wall Street, with investors focused on earnings as a major test of sentiment on equities.
Tesla jumping in late trade with a promise to fast-track cheaper models, taking the spotlight from some ugly sales and profit numbers.
Plus, Apple's China sales said to plunge 19% last quarter, putting it third in a key market as local rival Huawei surges.
All right, let's take a look at how we're shaping up for trades in the Asia Pacific. It looks like it's going to be pretty much a risk-on day. We did see gold prices ease a little bit, so maybe some of the miners, maybe some of the Japan gold ETFs could suffer a little bit. But broadly speaking, it looks like we're setting up for a positive start. New Zealand already a few points in positive territory. Interesting day on the data dockers as well. We're going to get first quarter CPI numbers out of Australia. That's going to be critical to the future path of rates here. Those numbers are seen easing to 3.5%, down from 4.1. It's a big improvement, still outside the RBA's target band. However, we're also getting a Bank of Indonesia decision later today. The consensus there is for a hold. Nikkei futures also in positive territory by 1/5%. We have heard that the Bank of Japan is going to focus on weakening the yen at its next meeting. Right now, we've got the yen 144.77. And also today, Bell, we're going to be keeping a close eye on those Tesla suppliers. The stock's surging after hours, especially following that analyst call.
Yeah, that's right. Really, very much an earnings call, perhaps, and a set of earnings that investors wanted to see for a company that has just slumped so much this year. But taking a look at what we've got for US futures that are just coming online, again, you're looking towards some further gains when we trade for the Wednesday session. But as you said, that story very much focused on earnings, and Tesla, one of the key ones. We can get to the after hours move in just a minute. But what else we were tracking today was just sort of the optimism that's coming back in, and the bullish forecast as well that we're hearing. If you change on, some of those are coming through, for instance, from Goldman Sachs. This was a company that actually closed at a record high, first record high that we've seen since 2021. But first quarter earnings came through last week. It included, as we know, a massive profit beat, and one analyst as well calling that a near perfect print. Apple also actually managing to post some gains, which was sort of surprising as well, given what came through with the China headline we just heard there. But first quarter China iPhone sales dropping nearly 20%. That's according to some research. It is just a story of China really continuing to lose advantage in that market. After hours, of course, that big focus. So Texas Instruments, another one that was very optimistic in its earnings, but the big move there coming through for Tesla after, as you said, Paul, very much an earnings report that traders and investors wanted to see here.
Yeah, let's get a bit more on Tesla's earnings and bring in our global business editor, Peter Vercoe. And Peter, suffice to say, all week we were building up to what was expected to be a pretty horrible quarter, and a horrible quarter we got, but shares surging after hours. Analysts really liking what they heard.
Yeah, well, I think the earnings report was immediately put in the rearview mirror, and what analysts were really looking for was the forward-looking comments from Musk, and particularly around strategy and a more affordable car. And he said what they wanted to hear, which was that they're going to accelerate the development of new models, including a more affordable car. On the earnings call, he didn't give an exact timeline, but he said early 2025, if not late this year. And that's a big bring forward, and also reassures analysts and investors, because there had been some speculation that the idea of a more affordable car was going to be shelved instead. It's a really important area for Tesla to get into. Something around 30% of car sales in the US are for cars priced below about $35,000, which is about where the Model Y comes in now after the recent price cuts and tax credits. And so that's a big chunk of the market to be missing out on, and they really need something to drive that next stage of growth at the company.
And perhaps the next stage of growth, could that be autonomous driving? We know that Elon Musk was very bullish about that. How significant is it to Tesla's future?
Yeah, Annabelle, like really significant. Like Musk really laid out a picture of Tesla as an autonomous driving company. At one stage saying on the investor call that if you didn't think that Tesla was going to solve autonomous driving, then you shouldn't be an investor in the company, and sort of urged everyone who was thinking about Tesla to go out and drive a Tesla with its latest version of full self-driving, the 12.3, saying it's impossible to understand the company without doing this. And he sort of like laid out this vision of Tesla with autonomous cars, where you're able to summon a car via an app. It takes you to your destination, you get out, and you don't even think about how the car got there. It just did. And he said it's going to be like, he sort of sees his vision or a future where Tesla is some kind of like combination of Airbnb and Uber, where they own some of the cars that's in this autonomous fleet, but also as a Tesla owner, you could put your car into the fleet to be used as a robo-taxi, and then take it out when you want to. He said, you know, rather than have your car sitting in the driveway where most cars spend most of their time, it will be out on the roads being used. At one stage, he was sort of like questioned about this, and his answer in a typical Musk way was like, well, tell us about this future horse-drawn carriage you're making. And his answer is, well, it doesn't need a horse. That's the whole point.
Yeah, certainly some interesting commentary coming out, quite colourful, Peter. And as we said, that stock surge in after hours with analysts liking what they heard in that earnings call, even though earnings, of course, are missed on a variety of metrics. But that was our global business editor, Peter Verco, there. And let's shift focus now to tensions between Beijing and the West, because China has launched its harshest attack yet on US complaints about industrial overcapacity ahead of the arrival of Secretary of State Antony Blinken. The Foreign Ministry says Washington has the malicious intent of curbing and suppressing China's industrial development, with claims that amount to naked economic coercion and bullying. Blinken arrives on Wednesday for a scheduled three-day visit. And let's get more on that outlook now for Sino-US relations. Bring in Ian Bremmer. He's president at Eurasia Group. And Ian, we've really rarely heard China holding such briefings before a top US official visit, and at the same time, rhetoric from the US is being dialed up as well, and more concrete actions like this possible ban on TikTok in the US. So is this just sort of setting us up for a further setback in relations in what's a very key election year as well?
The trend for this year has been more engagement, more communications, but not more trust. And so what that means is you still have plenty of areas that the countries are unhappy with each other, but that when there is conflict, the conflict does not escalate out of control. Rather, the escalations are targeted and calibrated. So we can say that the relationship is getting worse. It's true, but it's getting worse quite slowly. And there's more stability to the relationship than there was, for example, when we saw the balloon floating over the United States, or when we saw Pelosi, the former speaker, make her trip to Taiwan. So it's really whether you see it as glass half full or half empty, but there's a lot more intentionality to this relationship today than there has been over the past several years.
Yes, Balloon Gate, of course, we know, yes, there's been a lot more engagement and visits following that event. But I'm curious, because when you say more engagement, more communication, sometimes is the silent treatment, is that definitely worse when we had a lack of engagement?
Yeah, it's worse. I promise you it's worse. When you don't have military-to-military conversations, so that if something goes wrong, they're not talking to each other and they can misinterpret it, it's absolutely worse. One of the reasons why the U.S.-China relationship over Taiwan is more stable than, say, with the Philippines, the Second Thomas Shoal, the South China Sea, is because for 50 years, the U.S. and China know each other's red lines. They know what the challenges are in the relationship. They communicate constantly. So it's very easy to make extremely nuanced calibrations up and down in the tension of the relationship. It's why after we had an election a couple months ago that didn't go the way China wanted in the Taiwanese elections, that the Chinese response wasn't a strong and sudden escalation that brought the two sides to crises, nor will it be next month when former Vice President Lee becomes President Lee of Taiwan and his inauguration. It's always better to have more engagement, more conversations, especially when you don't trust each other. I mean, really what Biden has tried to do is make sure that if there are problems in the relationship, that China's not surprised. They don't find out from CNN or from Fox, that they find out directly from the interlocutors, that they show a level of respect. And the Chinese government has appreciated that. I do think that we have more stability in the relationship today than we did before the Woodside Summit in November, when Xi and Biden last met for several hours face to face.
Ian, in terms of silence being worse, we're probably going to get the opposite of silence pretty soon as we head into election season coming up in November in the US. One could expect the anti-China rhetoric could get pretty hot. When this kind of thing happens, is there a risk of causing lasting damage to the relationship, or does China just tend to view politics as politics?
You know, there is, but there's not as much pressure on the Americans to do that. I mean, frankly, the fact that the relationship has stabilized without Biden giving away the store, he hasn't pulled back on tariffs, for example, that were put in under Trump. He hasn't pulled back on export controls on semiconductors. You've got a new investigation into Chinese shipbuilding, which is being opened right now. You mentioned TikTok as well. You've got $2 billion of military support that's heading over to Taiwan as part of the $95 billion package now working its way through Senate. I mean, it's not as if Biden's taking a lot of inbound criticism from the Republicans on being too soft on China. It is one of the very few areas of foreign policy, not Russia, Ukraine, not the Middle East, Lord knows not the border issue. Biden's getting criticized from the Republicans on almost everything in foreign policy, but not on China. And that actually gives him a little bit more flexibility, more room to run in this election period on that specific relationship.
Yeah, in terms of the TikTok question, we did hear from Donald Trump blaming President Biden for what could amount to a TikTok ban. But of course, Trump himself tried to force the sale of TikTok when he was in power. So can you say with any certainty what a potential second Trump presidency would mean for the future of TikTok?
Well, I think as long as Trump continues to get a lot of money from people that want TikTok not to be banned, that he's going to stay in that camp. I mean, you're right. That's a 180 flip from Trump, but it's very consistent. He usually is willing to say whatever is required to go to the highest bidder in terms of his lobbyists and his donors, especially when he has to spend so much money on legal fees while he's contesting this campaign. So I think that's the most relevant, in fact, perhaps the only relevant data point that describes why Trump is in a different position right now.
All right, Ian Bremmer from Eurasia Group is going to be staying with us because still ahead we're going to be taking a closer look at tension in the Middle East, but also Tesla's results and its plan to speed up the launch of more affordable models. Deepwater's Gene Munster is going to share his outlook later in the hour.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA. A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Checking in on how the oil price is tracking right now. It's been a kind of an interesting few days for oil. In fact, we've got WTI prices just creeping up a little in early trading. Been a lot of whipsawing going on with questions over tension in the Middle East. We saw that big spike, of course, on Friday, but oil right now Still higher than where it was 5 days ago, and that's despite things seeming to calm down in the Mideast. Still with us now, we do have Ian Bremer, founder and president of the Eurasia Group. Ian, I just want to get your view on where we are in terms of Middle East tension at the moment. How confident are you that the risk of an escalated conflict between Iran and Israel has receded for now? And are we sort of back to that situation normal of just a simmering proxy war?
Yes and no. Last week's crisis is over between Israel and Iran. We're not about to see another major tit-for-tat strike by either side directly against the other. That was, of course, a concern of the markets a week ago. But this has not contained the broader war. The Americans at this point continue to expect, despite their ultimatum to the Israelis against this, that there will be a ground incursion in Rafah in the coming weeks, with over 1 million Palestinians sheltering there. That comes against the backdrop of a proxy war, with Iran leading the so-called axis of resistance, terrorist organizations that do not respect the right of Israel to exist, and they are engaging in strikes in the Red Sea, engaging in strikes against American, British, and other military targets in the region. This is still a very, very dangerous environment, and there's no broader ability to bring that war to an end.
Yeah, on the subject of the Rafah incursion, how close do you gauge Israel to being to its goal, or its stated goal, of eliminating Hamas? And is it realistic? And if it succeeds, what happens next?
You'll remember that in the early days after the October 7th terrorist attacks, that President Biden said that Israel needed to learn the lesson of 9/11, that the United States didn't just take out bin Laden, didn't just take out al-Qaeda, but attempted much broader wars against terror. Has the United States succeeded 20 years later in winning a war against terror? No one would say that. How about the Taliban? Well, they're back in Afghanistan. I think we're going to have a similar conversation about Hamas. Hamas itself may be destroyed as an organization, but if they are, they will be replaced by other militant organizations that have the same political ambitions. Not to mention the fact that Palestinians are much more radicalized in both Gaza and the West Bank on the back of the violence that we've seen over the last 6 months. So I fear, as much as I have great sympathy for the Israeli people in wanting to ensure that they can defend themselves and their children, and that you don't have a government that is run by a terrorist organization that wants to wipe them out, I think that the way that they have gone about that war has ultimately made them less secure and will ultimately make their enemies stronger, both in Gaza and more broadly.
So then, what are the odds of a ceasefire developing, and would there be any sort of timeline on that, given that you do have hardline approach on both sides?
Well, there was an effort to get a temporary ceasefire that many hoped could lead to a longer ceasefire if you had gotten many of these hostages that continued to be held by Hamas, civilian hostages, many of them in Gaza, left free. And of course, that hasn't happened, and it doesn't look close to happening. And absent that, I don't see a ceasefire from Israel occurring. I also don't see a ceasefire with this Israeli war cabinet as long as you have thousands and thousands of Hamas fighters on the ground in Gaza. Now, that may be working at counter purposes to their long-term stability, but this is not just a matter of the Israeli prime minister. The entire war cabinet believes that they have a lot more to do militarily in Gaza before they can declare mission accomplished, if you will. Not only that, but there's also the Hezbollah issue. The Israelis have evacuated almost 100,000 Jews from the north of Israel because they believe that they are not adequately defended and secure from rocket attacks that come from Hezbollah. if the Israelis do not in some way engage militarily against Hezbollah to ensure that safety, well, how are they supposed to announce that these people are going to come back? So that they've gotten themselves in a bit of a bind. It's very hard to see how they declare victory either in Gaza or with Hezbollah in the foreseeable future right now. It's really hard to see.
Do you think that, because it's clearly a conflict that's not just a couple of parties, there's so many different actors that are involved at this point, do you think that that Israel, but also most notably the US, sort of underestimated the amount of cooperation and collaboration you would see between Iran, between China, between Russia, between North Korea in this conflict, and also what's happening in Ukraine, that you just have these separate axes that are operating?
I don't think that there is a significant amount of help or support that is going to Iran in this war. Certainly, Russia and North Korea are very simpatico with Iran, and there's a lot of trade going on. There's technology that is being transferred. But I wouldn't say that Iran has had any greater success in this war on the back of those relations. I take exception to including China in that grouping, as you have. I know that some have done that. But when I look at Russia, Iran, and North Korea, I see three states that are considered rogues. They're pariahs for the United States and its allies. No meaningful diplomatic or economic relations with those countries. And all three of those countries are led by people who believe that chaos in the international order is to their advantage. China does not believe that. China recognizes they need a level of stability in the global order, including in the United States, to be successful and more powerful over time. Now, China is a friend of Russia. China certainly gets a lot of energy from Iran. They trade a lot with these countries. But they are not rooting for these wars to get worse. In fact, China would much rather see a ceasefire in Ukraine. China would much rather see a ceasefire between Israel and Hamas, where the Russians don't want that at all. The Russians want to see it all burn. And that is a much more dangerous position, especially for a country that is systemically important in their energy and other resource exports, as well as, of course, with their offensive cyber capabilities, military capabilities, espionage capabilities, and their nuclear capabilities.
Ian Bremer there, President at Eurasia Group. Thanks so much for your insights this evening. And we have plenty more to come on Daybreak Australia. This is Bloomberg.
Let's just take a quick look at how we're tracking in the currency space at the moment. The Bloomberg Dollar Spot Index backing off just a little. The Aussie dollar now knocking on the door of 65 cents. A couple of currencies out to watch in Asia, though. The yen, we've got the BOJ pledging to focus on weakening the currency at its upcoming policy meeting. That begins tomorrow. And China, meanwhile, saying the FX regulators are going to defend the bottom line of financial security. More in a moment on Daybreak Australia. This is Bloomberg. All right, let's take a look at how Tesla shares are tracking after hours. In a word, wow, better by 12%. That is going to make for a very interesting open for the stock in the US tomorrow. Obviously, we'll be keeping an eye on Tesla suppliers as well today. And what an earnings call it was. We were expecting a pretty wretched quarter out of Tesla, and it was indeed that, but it was all about the outlook and plenty of headlines coming out of that call as well. Let's get some more analysis on Tesla's outlook now with with Gene Munster. He's co-founder and managing partner at Deepwater Asset Management. Gene, I want to start off by talking about potential new models out of Tesla, because that was the headline that a lot of the media came away with. Early next year, maybe late this year, we could see new models, but detail very, very vague. Let me see. Executives really danced around multiple questions on that on the analyst call, and eventually Elon Musk himself just shut it all down. So what are you expecting in terms of cheaper, newer models?
So, Paul, I guess to start out some context, the timing piece is important. I want to highlight that they have talked in the last 6 months being between some growth curves. They're in this EV winter right now, and they've talked about the importance of this next generation platform. This is 3 months ago. And so the talk of them on the call today, just moving that time frame up by 9 months, is reaffirming to those Tesla investors that, in fact, we're going to reaccelerate growth earlier than what had been expected, call it 3 quarters early. So that's one piece of it. The second is this unanswered component to it, which is what is actually going on with their, like, what are these cars going to look like? And as you said, they shut it down, but there was just this sliver of information that Elon gave. He said that when he was talking about the robo-taxi, and the question came up on the call, is this related to the robo-taxi? And he said, I'm not going to answer questions. I've said what I'm going to say and wait till August 8th to hear more. And so based on that, you can read between the lines. They're probably going to talk about the robo-taxi as this next-gen car on August 8th. It's hard to believe that they think that they can get that car out and approved within a year, but this is Tesla, and they make big, bold predictions.
Yeah, to give a bit of context around that, it took 4 years for the Cybertruck to go from announcement to actual delivery, but Tesla says it's not going to need a new factory to do this. Does that give you any clues?
It does. I mean, I think that they can build this car. They can get this car to market from in the next year. I think that that's very possible. That's different than in 2019 when he talked about 1 million robo-taxis on the road at the end of the year. They had basically very limited production at that time. And so I think that that dynamic is different. The piece that doesn't quite sit well with me is just there's the side of building the technology and there's the side of getting approval. They did mention that a few states have made that approval and they expect more to come. But to me, that's probably the biggest bottleneck. I think that them manufacturing those at their existing facility does increase the probability. And let me cut to the chase on my bottom line here is they're not going to get a car out. They're not going to get a robo-taxi out in a year, but they probably do in 2 years. And if they do that in 2 years, I think that shares go higher.
How much demand, though, do you think there would be for an autonomous self-driving car?
Well, I think there'll be a lot of demand. I think that not only will there be demand, I suspect that for safety reasons, that other car makers are going to be required to have autonomy. And to put it in a perspective, just some quick numbers, at least related to the U.S., is that 42,000 people lost their lives in 2023 from auto accidents. That's up from 37,000 in 2013. So over the past decade, that has surprisingly increased. Of course, the reason is people are distracted. So I think that the opportunity around just making cars safer is one big piece to this. The second is what's the market for people essentially moving around for much cheaper. Imagine using Lyft or Uber at a 50% reduction in the current price. And I think that that's very appealing. And Elon talked on the call about 7 to 10 million vehicles being autonomous. I think you can kind of throw those out the window. Who knows what the number is? But if they solve for autonomy, this will be a true breakthrough, a kind of a once in 100 years breakthrough in terms of how people move.
What do you think about the pricing of that as well? Because it seems like it'd be a more expensive vehicle, but at the same time, we've seen a really slack EV market and Tesla pushing through price cuts to try and regain market share or gain further market share.
So 2 topics when it comes to pricing. One is just the current pricing environment, and surprisingly, ASPs, despite what we've seen in those headline price cuts, average selling prices in the March quarter was flat. It was actually up 1% from the December quarter. And the Cybertruck kind of played in that higher trim Model Y. But so ASPs have been surprisingly stable given the overall environment. When it comes to the price of FSD, they've recently lowered that. And so they're making this available if you buy it up front for a third less, going from around $12,000 to $9,000 if you buy it up front. And so there are definitely some moving parts around autonomy and how people are buying it, whether it's upfront or through subscription. The simple takeaway is this, is that when you put all this together and think about a robo-taxi that has autonomy, the average price of that vehicle autonomously will be much less, call it 20, 30% less than the average price of a new car today, which at least in the US is kind of around $45,000. So I think pricing of these vehicles is going down, and I think that profitability can actually increase at the same time, given the potential around charging more for FSD long term.
Gene, one of the other things that Tesla talked about on this call was this idea of unboxed manufacturing and how that would revolutionize car production. What does that mean to you? What is it?
So if you think about the concept of how cars have been made, it's traditionally a manufacturing line. And essentially what unboxed means is that you are building these cars in these modules in the manufacturing facility. And so people kind of come to the car and add different parts to it. So it's just it's a different way. It's like flipping the whole manufacturing process. I'm sure Henry Ford is not feeling good about this concept, but it has the potential to meaningfully reduce the cost of building a car. And I think that Elon has talked over the years about being one of the competitive advantages of Tesla is building the machine that makes the machine, focusing on the factory piece. You don't hear about other car makers talking about this, but that is what is relevant to this whole unboxed approach. It's just a new paradigm in terms of manufacturing that can dramatically lower the cost, very similar to what the assembly line did 130 years ago.
We've got a chart here that shows short interest in Tesla stock. Been here before, haven't we? That's now at its highest in 2.5 years. And then today we saw the stock going up more than 12% after hours. Do you feel like the scene is set here for another big battle between the shorts and the true believers of Tesla? And what's your price outlook?
It's going to be an exciting 2 years, I would say, if you're an investor or if you're just a bystander watching this company progress, because one of two things is going to happen. This company is going to flourish, or this company is just going to be yet another automaker. And it is a very similar setup to what was going on in 2016, 2017, when they were trying to break through with Model 3 production. So this is not a bet the company on autonomy and the robo-taxi, but I would describe this as them being all in on that. And so to put it on the most basic level is that this comes down to, for investors, almost a religious question. Do you believe that the future is autonomous? If you think that electrification and autonomy is the future, Tesla by far is in the best position to capitalize on that. If you think that that future is further off, 10 years, 20 years off, then the stock's not going to do anything. And it is going to be really difficult to get those investors who are in those different camps to really think straight about what the other side is. So this is going to be a polarizing company, undoubtedly a polarizing stock for the next few years.
Yeah, Gene, and as we speak, of course, Tesla is searching more than 12% in after hours, but that was Gene Munster, co-founder and managing partner at Deepwater Asset Management. Shifting to Apple now, because independent research firm Counterpoint Research reports that the company's iPhone sales in China fell 19% during the March quarter. That drop is the gadget's worst performance in the country since 2020. For more, Bloomberg tech reporter Mark Gurman joins us. And Mark, there's a weak consumer, of course, in China, but there's also shifting consumer preferences. And it's that latter part that seems a lot more difficult to change now.
I think you're right. I think it does come down to consumer preferences in China, because the smartphone market in China is not down overall. You're seeing pretty substantial growth for brands like Honor. You're seeing a lack of growth, but also no declines for some of the other brands there. So this is really about the iPhone and consumers in China picking other products instead of the iPhone in numbers that they haven't since the beginning of the COVID pandemic. So certainly Apple has some issues in China. They need to remarket the device, reposition the device, make upgrades that are tailored to the Chinese market. They don't do much to really tailor their products to China. Sure, they have everything geographically optimized, but there's no specific features or enhancements there for that country. It's basically a translated version of the iPhone sold in every other country. But China, as you know, really needs some special hardware and software to make it more unique to that market. Perhaps they do, in the future, better integration with things like WeChat or some of the other applications and super apps in China that really sell devices there. More optimization for local services. The other thing they can do is a low-cost iPhone at some point. I doubt it'll happen, but they do have levers to pull. It's just about whether or not they're willing to do it.
And Mark, connected to that, how's Apple's progress on AI deployment?
Yeah, so AI, that's the talk about Apple right now. Here's the thing. They're going to announce a slew of new AI features June 10th at their Worldwide Developers Conference. The big question I have is not necessarily how good are they going to be, but are users really going to use them? Are mass consumers really going to care? Or is this about simply appeasing the stock price, right? If Apple's willing to chase the market, right, chase what Wall Street wants by adding a slew of AI features to its device in rapid fashion, why aren't they willing to do the same thing with a lower cost iPhone and meet customers and meet Wall Street with what they want for something as important as the iPhone, right? So certainly it's going to be exciting to see what features they add. I'm not really sure consumers are going to care in large numbers.
That was our Bloomberg technology reporter, Mark Gurman, there, and we'll have more ahead on Daybreak Australia. This is Bloomberg.
Even when we go into a recession, the consumer's in good shape. But that doesn't mean you can fight off the effects of stagflation or something like that if it gets much worse. And so, you know, I worry that it looks more like the 70s than we've seen before. If you go back to the 70s, deficits were half what they are today. The debt to GDP was 35%, not 100%. And so part of the reason I think we've had this strong growth is the fiscal spending.
That was JP Morgan CEO Jamie Dimon on the strength of US consumers. And let's get a check now of morning calls ahead of the Asia trading day. And amid discussions around the US economy, corporate earnings, Morgan Stanley's Mike Wilson says he's avoiding any kind of big market calls on the S&P 500. Instead, he's focused on finding opportunities beneath the surface.
I think you just got to keep a really flexible, open mind. That's what we try to do now with the stock picking. We haven't really talked much about index in the last 4 or 5 months because we're trying to focus on the relative value trades. And we've gotten a lot of those right. And hopefully, knock on wood, we can continue to do that.
And turning to the yen, Japan's former top currency official says we're on the brink of currency intervention if the yen weakens further. Former Vice Finance Minister Mitsuhiro Furusawa noted the yen's rapid depreciation against the dollar, despite there being no change in US and Japanese interest rates. He says intervention will come if that trend continues.
Well, the weak Japanese yen might have helped the country's shares climb to records. Traders now, though, say it's gone a bit too far. Our senior Asia stock reporter Hideyuki Sano joins us now. Hideyuki, why have they changed their mind now?
Hi, Paul. That's a very interesting point. And I guess the short answer is that the pain of a weaker yen is becoming more palpable in every corner of the economy. You know, the stock market has liked cheaper yen mainly because that is going to benefit the exporters and companies like Toyota and Honda. They are big players in Japanese stock market. So on the whole, the yen, a weaker yen was thought to be beneficial to Japanese stocks. But the truth is, where the light is brightest, the shadows are the darkest. And you can find the shadow in the country's consumer sectors. I mean, if you look at the consumer consumption index provided by the Bank of Japan, actually it hit the lowest level in 2 years in the last quarter, excluding boost from inbound tourists. So consumption has been really sluggish in Japan, but investors have basically shrugged this off, mainly because we had such a huge wage hike that the things should be improving later this year. But the problem is a weaker yen is calling that scenario into question. Now, so if the yen continues to weaken, then obviously, the scenario that there will be a positive cycle of rising inflation, the wages could be questioned, because we may not have a real sort of wage growth in the end. So that completely changed the assumption. So that is why investors are now really concerned about the yen's weakness.
Yeah, that's been really the big question, Hideyuki. Would a weak yen hurt consumption? And it's interesting because, as you said, following the wage negotiations and the positive outcome from that, we did see a big lift for consumption-related shares. But what's been happening in that period since?
Yeah, so I mean, if you look at the stock market, the domestic sectors have been very sluggish. And I think the best example is the land transport index, which is basically railway companies or transport companies. So they have benefited hugely from the record high inbound tourism. But despite that, their shares have been basically flat since the start of this year, compared to a gain of something like 30% in the broader market. So that is a very good example. Another one probably is retailers. Now, they are not pure domestic play these days, because many companies started to expand their business overseas. So their bottom line will be affected by a lot of factors outside Japan, but still they also significantly underperform the overall market. So clearly investors are already worried about the state of the domestic economy.
That was our senior Asia stock reporter, Hideyuki Sano there. And be sure to tune in to Bloomberg Radio to hear more from the day's big newsmakers and get in-depth analysis from the Daybreak team broadcasting live from our studio in Hong Kong. You can listen via the app, Radio Plus, or BloombergRadio.com. We'll have plenty more ahead. Stay with us. Just a quick note of data coming out March. Services producer prices rising 2.3% on the year. The estimate had been for a reading of 2.1%. So that is more than economists had been expecting, of course, and it's actually an uptick as well from the reading prior that's just been revised to 2.2%, up from 2.1%. So, Paul, it just continues to be that story of more inflationary signals that are coming in Japan, the question of the weak yen and how much that's playing into it, but something to track quite closely, even though the BOJ, of course, still expects inflation to trend lower into year-end and no changes expected at their meeting later this week.
Yeah, we're keeping an eye also on shares of Europe's biggest software company, SAP. They're rising the most since January after it forecast record revenue expansion from its cloud services. CFO Dominic Asam told us it's all down to the boom in artificial intelligence.
The advent of AI has clearly propelled the story of the transformation to the cloud, to move our customers from their on-prem installations onto cloud, resulting in an uptick on a constant currency basis by 25% in our cloud revenues. Our more forward-looking so-called CCB, which is basically the 12-month ahead subscription revenues we've already contractually locked in, is even growing at 28%. That's a record growth. And all that is driven really by the core offering we have in the cloud, which is called the Cloud ERP Suite. That offering has actually generated in excess of 30% growth for 9 quarters in a row now.
What is the demand, Dominic, in terms of the specific applications of artificial intelligence in the cloud that you see most commonly invested in by the companies who are your clients?
Well, it's a broad set of applications throughout the enterprise, on HR, on finance, on the supply chain. So there's actually no exclusion, I would say. It's really, really broad, We have brought about 30 use cases recently to the market. We are planning another 100 to come. We already have more than 27,000 customers using AI-powered use cases in the corporation. The 300 million users we have by now in the cloud are really benefiting to make themselves more productive and to fight, for instance, rising inflation and salaries.
How much are you winning market share versus simply just capitalizing on the incredible demand that we see right now for artificial intelligence?
Well, undoubtedly on the Cloud ERP suite, we do win market share. I mentioned the 30% plus growth we have. The market is more in the low to mid-teens. So that's a very tremendous outperformance. It's like more than twice the performance of the market.
So from who? Who are you gaining market share from in particular?
Well, sometimes it's kind of homemade solutions we are displacing. Sometimes it's also against our key competitors. It's also the fact that SAP has been more focused on the on-prem installations, i.e. software deployed by the customers. Now we're really moving to the cloud. So we can convert that huge customer base on-prem into the cloud, and that drives the growth.
That was the SAP CFO, Dominik Asam, speaking with Bloomberg's Lisa Abramovich. And these are the stocks we're going to be watching when trade opens in Korea, Japan and Australia in just a few minutes. Tesla's Asian peers and suppliers, of course, still a focus for us. The EV maker, we know, is trying to move investors' attention away from a tough first quarter and onto its plans for cheaper cars and a fleet of robotaxi. Tesla to note up more than 12% in after hours. And you can also watch Asian chip makers. That's after US peers rallied overnight. And Texas Instruments, another name that's been surging in after hours, giving a strong revenue forecast. Plus, keep an eye on Apple supplies after Counterpoint Research said iPhone sales in China fell almost 20% during the March quarter.
Let's take a quick look at how we're tracking in the commodity space. And on the subject of China, Chinese producers really balking at the high prices for copper at the moment. We did see a big rally for copper towards the end of the session in London. But Chile, also the world's biggest copper producer, is trimming its estimates for production. So we might see a few pressures on the copper price there. Iron ore, meanwhile, that seems to be finding a floor. It's actually ticking up a little bit, $114.40 per tonne. Got market opens in Sydney, Seoul and Tokyo up next. This is Bloomberg.